Have you ever wondered how to develop a dividend investing strategy? You're in the right place. In this comprehensive guide, we'll delve into the nuts and bolts of dividend investing, from understanding the basics to analyzing dividend stocks and crafting your very own investment plan. We'll also discuss common strategies and how to avoid typical pitfalls. So, whether you're a seasoned investor or just starting out, there's something for everyone. Stay tuned as we unfold the secrets of dividend investing. Firstly, let's understand what dividend investing is. At its core, dividend investing is an approach that focuses on buying shares of companies that regularly distribute a portion of their profits back to shareholders. These distributions are known as dividends. The purpose of this strategy is to create a steady stream of income, separate from any potential capital gains. In essence, it's akin to receiving a regular paycheck from your investments. The way it works is pretty straightforward. When a company turns a profit, instead of reinvesting all of it back into the business, they decide to share a piece of the pie with their shareholders. This payout can come in various forms, but it's often in the form of cash or additional shares. Dividend investing is a popular strategy among investors looking for both income and long-term growth. Now that we know what dividend investing is, let's dig deeper. But why should one consider dividend investing, you may ask? Well, dividend investing comes with its own set of advantages. Let's delve into them. First up, it provides a steady stream of income, which can be particularly appealing if you're looking for regular payouts to supplement your income. This can be especially beneficial for retirees who need a consistent income source. Secondly, dividend investing offers the potential for long-term growth. How so? As you reinvest your dividends, you're able to purchase more shares, which can result in compound growth over time. Moreover, companies that consistently pay dividends are generally more stable and established. This can reduce the overall risk of your investment portfolio. In essence, dividend investing can provide you with a cushion during volatile market conditions, while still offering a chance to partake in the company's success. Clearly, dividend investing has its perks. But how are dividends paid? Let's explore this in the next section. Dividends are paid in a number of ways. The most common method is cash dividends, where companies distribute earnings directly to shareholders in the form of cash. This is typically expressed as a fixed amount per share. Next, we have stock dividends. Instead of cash, companies issue additional shares to their shareholders. This increases the total number of shares owned while decreasing the price of each share. Then there's property dividends. While less common, some companies may distribute property, which can include physical assets or even shares from a subsidiary company, as a form of dividend. Finally, we come across special dividends. These are one-time payments made by companies in addition to regular dividends, usually following particularly profitable periods or the sale of a business segment. Each of these methods reflects the company's financial health, strategic goals, and commitment to its shareholders. With these payment methods in mind, let's explore how to analyze dividend stocks. Not all dividend stocks are created equal. Indeed, a flashy dividend yield can be alluring, but it's crucial to dig deeper. Analyzing dividend stocks involves a bit of detective work. Firstly, look for companies with a track record of steadily increasing dividends. This signifies financial health and commitment to returning profits to shareholders. Next, consider the company's payout ratio. This is the proportion of earnings paid out as dividends. A high ratio may seem attractive, but it could indicate the company is overextending itself, risking future payouts. Then there's the matter of free cash flow. Companies with strong free cash flow are more likely to sustain their dividends, even during economic downturns. Lastly, remember to consider the company's sector and market conditions. Certain sectors like utilities and consumer staples tend to be reliable dividend payers. Beware of dividend traps. These are companies with high yields due to falling stock prices, not because of increasing dividends. Armed with this knowledge, we can now create a dividend investing plan. Creating a dividend investing plan is a step-by-step process. Just like a chef creating a new recipe, an investor must first understand their ingredients and tools. The first step is to assess your risk tolerance. Are you comfortable with volatility, or do you prefer a more stable, slow and steady approach? This will guide your decisions on which dividend-paying companies to invest in. Next, determine your portfolio allocation. This involves deciding how much of your portfolio you wish to dedicate to dividend investing. A balanced approach might involve a mix of growth stocks, dividend stocks, and bonds. After that, it's time to select your investment vehicles. Do you prefer individual dividend-paying stocks, or would you rather spread your risk with dividend-focused exchange-traded funds or mutual funds? There are pros and cons to each, and the right choice depends on your individual circumstances and goals. Now that we have a plan, let's look at some common strategies. There are several strategies to choose from in dividend investing. First, there's the high dividend yield strategy. Investors following this approach seek out companies that offer high dividend yields compared to the market average. This strategy can provide a steady income stream, but also carries the risk of investing in companies that may not be financially stable. Next, we have the dividend growth strategy. Here, the focus is on companies that consistently increase their dividends over time. This strategy is less about the immediate income and more about the potential for long-term growth and compounding returns. Lastly, there's the dividend income strategy, which centers on generating a substantial part of the investor's income from dividends. This is popular among retirees who may rely on this income for their day-to-day expenses. Each of these strategies caters to different investor goals and risk preferences. Once you've chosen a strategy, it's time to implement it. Implementation is where the rubber meets the road. Now that you've chosen your dividend investing strategy, it's time to put it into action. But before you dive in, there are some important considerations. First, look into the financial health of the companies you're considering. A company in good financial standing is more likely to sustain its dividend payouts over time. Tools like Morningstar's U.S. Dividend Valuation Index can be invaluable. This index uses the distance to default score, a measure of a company's risk of default, to help identify companies at risk of dividend cuts. Furthermore, consider the company's future prospects. Is the company well positioned to grow? Does it operate in a stable industry? These factors can provide insight into the sustainability of its dividends. While implementing, remember to avoid common mistakes. Always remain vigilant about the potential pitfalls and stay focused on your long-term investment goals. Even seasoned investors can make mistakes. In the realm of dividend investing, pitfalls can be plentiful. One of the most common missteps is chasing high-yield stocks without considering the sustainability of those dividends. High yields can be a sign of financial distress, and such companies may cut or eliminate their dividends in the future. Another mistake is neglecting to diversify your portfolio. Investing in a range of industries can help mitigate risk and ensure a steady stream of income. Remember, all eggs in one basket can lead to disaster. Focusing solely on dividend yield rather than total return is another common error. Total return, which includes both dividend income and capital appreciation, provides a more holistic view of an investment's performance. Lastly, never forget the importance of regular portfolio reviews. Market conditions change, and so too should your investments. Avoiding these mistakes can set you on the path to success. To wrap it up, dividend investing can indeed be a powerful tool in your investment arsenal. In our journey today, we've delved deep into the intricacies of this strategy. We've understood that dividend investing is about generating a steady income from companies that distribute profits to shareholders. We've seen the dual benefit this strategy offers, a consistent income stream and potential for long-term growth. It's a way to reduce the overall risk of your portfolio, thanks to the stability of companies that pay dividends. We've learned about the various methods companies use to distribute dividends: cash, stock, property, and special dividends, each reflecting the company's financial health and priorities. We've also understood the importance of thorough research to avoid dividend traps and ensure sustainable payouts. We've mapped out how to create a dividend investing plan, taking into account your risk tolerance, portfolio allocation, and suitable investment vehicles. We've also explored common dividend investing strategies that cater to different investor goals and risk preferences. Finally, we've highlighted the importance of a forward-looking evaluation of a company's financial health and valuations while implementing your strategy and the common mistakes to avoid. In the grand scheme of things, by adopting a dividend investing strategy, you can secure a steady income, achieve long-term growth, and mitigate portfolio risks. Remember, the secret of successful dividend investing lies in choosing financially strong companies. Happy investing.